What are we excited to learn about? We've pulled together 3 experts from the fields of mobile payment technologies, crowdfunding and retail services to talk to us about innovation in money. It's a hot topic. Bitcoin is on the boil, the new Westfield online mall has just been launched, and crowdfunded investments are on the table for ASIC approval. So we want to hear how the established definitions of money are changing. We want to hear about the challenges of gaining trust for new currency platforms. We want to hear about the impact of new technologies on our spending and lending patterns. And we want to hear how old and new institutions are responding to the challenges of collaborative consumption, alternative fundraising models, and the rejection of invasive selling. So first, looking at the big picture and a very wide open question, Jonathan, how do you think the way that we raise, spend and lend money is changing most and why?
Well, how we spend money is probably more of my area of expertise, and I suppose there's probably 3 big things that I would say that are changing quite rapidly. Number one, it doesn't take a rocket scientist to figure it out, is mobile. What we've seen from 2010 to 2013 is a 5,000% increase of people purchasing off a mobile phone through our rails at PayPal. Next, I'd say then is we've already seen contactless come into Australia. That's just going to take off even further. And the next one is, well, what's going to work within the phone? And then the third one, I think, is what happens with digital currencies like Bitcoin. And I think that's the big unknown right now. I don't think that the definition of money is changing. I think that the way that a consumer wants to spend their money and the way that they'll interact is what's changing.
Small startups companies definitely have a lot of advantage in terms of driving innovation because they got nothing to lose when they start, and they can't afford to go and experiment. It doesn't work and just ditch the idea and change another one. But big institutional banks, and they can't afford that.
Well, what we already know today, 67% of all consumers in Australia start on one form of medium and buy in another. So they look online, buy in store. They go in store, buy online, or they buy off their phone. So we already know that happens today with 67% of Australians. Now, the next evolution of that, in between, however virtually that happens, I think it looks at how retail embraces it and what they do with it.
I can pay for a taxi now with my iPhone. Why can't I, in any meaningful way, pay for something in a shop, and when is that going to change?
It's not just about the banks, it's also about the card issuers, right? So it's like Visa, MasterCard, and Amex to a lesser extent. But they've banked heavily on EMV. If those card issuers have got an inherent interest in maintaining that piece of plastic right now, until they find an alternative to be able to own the wallet, the digital wallet. Google and Apple are suffering the inverse problem, which is no one accepts it. Can't use it yet. You've got lots of players and each one wants to own the wallet. So no one's going to win right now. You need to wait and see, well, which one of these critical mass pieces is actually going to be the one that gets over the tipping point.
The reason for Bitcoin to exist is because we need a global currency. Our current financial system is so old, nothing has changed probably for the last 30 years. It's ridiculous that in Australia, there's only one bank can process different currencies and settle in different currencies. In Australia, there's only one NAB can ever do that. If they say no to you, your business is gone. Forget about it. The amount of Bitcoin total in value is not going to make a huge difference in the world. But I think this form is very important to be recognized. Mm-hmm. And this innovation direction is great.
The interesting thing about that comparison between Facebook currency and Facebook credits, I should say, and Bitcoin is that Bitcoin is truly a currency in itself. So think about the Amazon ecosystem, the iTunes ecosystem, the Apple ecosystem. Facebook is attempting to make the same kind of ecosystem. What's the feature of those ecosystems? Once the money's in, it doesn't come out.
We would never sell it.
You'd never sell it?
No, just that. Full stop. That data that goes in a vault and it's gone.
For us, that's a fire straight away. Anyone gets some data on Possible or try to get it out, it's a fire straight away. That is not a business model, it's not a revenue model. We'll never get our hands on it, we'll never sell it. Like if Possible tomorrow closed down, all the data get buried.
What did we learn today? We learned that the definition of money and currency isn't changing, but the way that we spend it is. It's not a question of technical change, organisational change necessarily, it's about behaviour change. And there's a young, mobile, highly disposable income group of people with a lower risk aversion than before. And yet this group still has the same basic need for trust. Possible and PayPal would rather die than give your data away. And this issue of collaborative consumption is at odds with the control that the market and the big banks are trying to exert and control the pace of innovation. It feels like we're also at three major tipping points. Bitcoin's at a tipping point. At the moment, it's as an investment currency, or it's being used for grey market goods, and it's yet to really translate into a proper transactional digital currency. At the moment, online, offline retail experiences are still a bit clunky, but beacons coming from PayPal, and it might be the winning ticket that merges online, offline experiences. And finally, investment from crowdfunding is in the government's hands. If they can lower compliance rates, we'll actually keep the money. If they don't, we'll probably drive that money overseas.